Holy smokes, everyone. Banks right now are hoarding cash. They're desperately trying to crash the markets. And in this video, I'm going to go over exactly why. Because many people may think that the banks don't want to crash the markets or hedge funds don't want to crash the markets. They may think that they only want the markets to go up. But people, that is not true. Banks and hedge funds, they are opportunists. And they're going to take huge advantage of the market crash when it comes, because people, it doesn't affect them. It is your money that they're losing, not theirs. And them, when they need money, they can just call up Papa Pow and get $1 trillion like that. Hey, Papa Pow, can I have $1 trillion? Sure, you can have $1 trillion, JP Morgan. That's all I got. But in all seriousness now, people, let's get into the news, the facts, and the data, how banks and hedge funds are hoarding cash and how they're spreading fear and desperately trying to crash the markets. But we can also use this as a huge buying opportunity that may be coming ahead. So everyone, let's get into it. Well, I'm sure you've been seeing lots of things like this in the media, everyone. Goldman sees Fed hiking 7 times in 2022 instead of 5. And again, what are we seeing? We're seeing banks saying the Fed's going to rate 5 times, and Goldman Sachs saying no, 7 times. Then JP Morgan saying no, 8 times. We can see this as a targeted campaign by the hedge funds, by the investment banks to spread fear out there, to cause panic and to cause a crash. But later in the video, I'm going to go over how it could actually be much worse than this and how nobody is preparing for a scenario where it's going to be much more rate hikes than 7 or 8. And there's a huge debate going on right now at Wall Street whether the Federal Reserve will lift interest rates by 0.25% in March or by half a percentage point. Listen to this. While many Fed officials are not in favor of bigger jumps, St. Louis Fed President James Bullard said he supports raising interest rates by a full percentage point by the start of July, including the first half-point rate hike since 2000, in response to the hottest inflation in 4 decades. And you know what? I completely agree with the Fed President James Bullard, and I think the other Fed presidents got to get on board, but unfortunately they're very dovish. They don't want to hurt their retirement portfolios, so they're saying, look, we can afford to, take our time here. People, they cannot to afford it. The middle class is getting destroyed. They're getting decimated right now. They need to do something about this inflation right now. Yes, they can afford it with their $1 million portfolios, but the middle class cannot afford another 10% increase in living costs. And our favorite bank, Deutsche Bank, they're now weighing in on the situation as well. Deutsche Bank economists has said that inflation data means a 50% basis point hike in March is now their base case. Economists at German banks said in a note, they tip further moves of 25 basis points at every meeting this year except for November, bringing the total increase in the Fed's fund rate in 2022 to 1.75%. And HSBC has also joined the party, predicting there'll be a half a percentage increase in March as well. But you know what I've been hearing a lot lately? I've been hearing people saying, well, don't worry, the markets have already priced in all these rate hikes. And don't worry, because during past times when the Federal Reserve have lifted interest rates, the markets have continued their rally. Well, everyone, this time is very different. And I know that's a very dangerous thing to say, but I've got proof and data to show you that this time is very different. Because I'll bring up a chart here that shows you what the stock market valuations were before the previous Federal Reserve rate hike cycles, and they're much lower than they were today. So look at this, everyone. Let's start off with 1983. We can see here that the price to earnings ratio of stocks was 18.7, so much lower than today of 22.8. In 1986, it was 14.8. In 1988, it was 12.5. Look at the only time it was higher today, 1999. And what happened in 1999? If I remember correctly, things didn't turn out too great. We had the biggest tech stock market crash of history, the dot-com crash. And what have we had in 2020 and 2021, everyone? We've had a boom of profitless growth tech stocks. And what has started to happen? They've already started to crash. And some people may think that this is a bottom. But during the dot-com crash, many stocks fell up to 95%. But looking back to more recent times in history, in 2004, again, the valuations, the PE ratios was 19.4. In 2016, the last time the Federal Reserve started lifting interest rates, it was only 19.3. So Bank of America, for some reason, is saying it's 22.8. But the data I have, it is saying it's 35. Look at this, everyone. This is the S&P 500 PE ratio. The data I had, the latest data, is showing 25.5. So yes, what normally happens in the stock market is they try to price in Federal Reserve rate hikes before it happens. That's why when the Federal Reserve does start lifting interest rates, we won't see a sell-off, because we're seeing a sell-off now. But what you have to know is this time the stock market is starting at much higher valuations. And the only reason we've had stocks go so parabolic is because of something called TINA. there is no other alternative. A lot of retirees that maybe didn't want to invest in the stock market, they had no choice but to go in the stock market because the 10-year US Treasury yield fell to 0.6%. But what if the 10-year yield goes back up to 5%? A lot of these retirees or risk-off investors go back into bonds to get a pretty decent return of 5%. Also, margin debt is at record levels, so margin costs are going to go up for a lot of investors. So you're going to have a lot of investors sell off margin, and we're seeing a lot of YouTubers that have been playing with margin lately have got absolutely wrecked. And margin debt and the stock market is very correlated. So if we see a lot of margin debt dumping, I think we're going to see more selling pressure for stocks. But many people have also said the Federal Reserve won't do anything and this inflation will be good for the stock market. Well, Bank of America and many people are saying it could actually be much worse. Listen to this. Bank of America strategists believe that risk to equities would be greater if the Fed did nothing. Runaway inflation would likely compress S&P 500 multiples and cut into earnings. And that's exactly what we've seen this past earnings season in the stock market. We've seen revenue go up, but that's simply because of inflation and people having to spend more or pay more for the same items. But we've also seen for some companies, inflation and the supply chain issues have actually hurt their profit margins and hurt their revenue growth. So it'll be very interesting to see what the Q1 results are the next earnings season. But we've just got some new critical bit of information what the 1% is doing with their money right now and what these banks' wealthy clients are doing. Look at this. Bank of America clients haven't been this bearish on tech stocks since 2006. Fed's quick-fire rate hike path seen as a major risk for tech. Equity allocations dropped to 31% overweight from 55% in January. So I'll bring up the chart here so you can see that net allocation for tech stocks have fallen to their lowest since 2006. So look what these wealthy clients are doing. They're doing pretty much what I've been doing for the past 6 months. Bank of America Global Fund Manager survey shows investors are piling into cash. Look, cash is their highest position at 38%, equities 31%, commodities 31%, and bonds -72%. Well, you may think, why are investors piling into cash right now if inflation is surging and they say cash is trash, you don't want to be in cash right now? And why, yes, that is true over the long term, but if you only lose 7% to inflation, that's better than losing 20 or 30% if stocks continue to fall further. But I'm also not 100% in cash, and that's why I'm using gold and silver as a hedge, because inflation does surge higher and the markets don't crash, gold and silver should perform great as well. And for all you buy the dip buyers that have brought the past 50 dips that seem to keep on dipping, this is what hedge funds are saying now as well. Well, hedge fund manager Doug says his bearish case is now stronger and dip buyers should buy their time. And he thinks the stock market still has at least a 50% correction to go. But again, going back to what I was talking about at the beginning, everyone, banks have been preparing for this, and banks are going to profit massively if the stock market crashes, and maybe they want it to crash, because look at this, everyone. This is what the banks have been doing for the past year. They've been piling more and more cash at the Federal Reserve reverse repo markets. You can see here in 2021, they were just parking 70 billion a day. But that has since surged now, and banks are now parking over $1 trillion, and it did hit around 2 trillion every single day at the Federal Reserve, waiting for the crash to come. And then they're going to use this cash they're hoarding at the Federal Reserve to go up and buy the mega dip. Do you have all these banks saying there's going to be 7, 8 rate hikes? Well, what nobody is talking about and what nobody is preparing for is the unthinkable, everyone. What if inflation doesn't go away? What if inflation goes worse? And what if they have to jack interest rates up to meet inflation if inflation gets up to 15%, or the CPI finally shows the real inflation rate of 15% and the Federal Reserve over a 2-year time frame? Because remember, don't get caught up in the short term. What if over a 2-year time frame, they have to lift interest rates up to 15% to get inflation down? Now, I know you may think this is impossible and it will never happen, and why I'm not saying it's going to definitely happen, it still is a risk that I think we have to be prepared for. Because even though the 80s may seem like a lifetime ago, people, when you look over history, a 40-year time frame is a very small time frame. And it is not unthinkable that this couldn't happen again. And this surging crazy inflation is the price we're paying for our leaders, for central banks kicking the can down the road for the past 40 years. They can't just keep doing it forever, everyone. So you're probably thinking, okay, but what can we do right now to protect ourselves and take advantage of the possible opportunities that are going to be coming ahead? Well, like I've been saying, everyone, I've been consistent. I've been saying this sell-off isn't over and you have to be patient. Don't just FOMO into these rallies because there's going to be rallies in bear markets. But the overall trend I think is we're heading lower. And what I'm doing personally is I'm waiting for stocks to fall 20 or 30% from their all-time high. Again, we'll have to continue to look at the data, but then I'll have a margin of safety and I'm not going to go all in at one time because like I said, nobody can predict the bottom, nobody can predict the market, but you can get a good chunk in the macroeconomic cycle. So what I'll do is then I'll start dollar cost averaging in. And I'm also a long-term believer in Bitcoin. We've seen as banks have started freezing people's bank accounts, people have been using Bitcoin as an alternative. So I think Bitcoin does have a good use case long-term for situations like that. So again, I'm waiting for Bitcoin to fall between 25 and 20,000 for me to start buying back into Bitcoin. Because even though we've had a recent rally in Bitcoin, I do think we are in a bear market and it is going to head lower. But everyone, that's just my thoughts and opinions and my perspective on the situation. I'm open to debate, open to discussion. So what do you think? Let me know. For all my loyal viewers and subscribers still watching, you're awesome. If you're interested, get up to 5 free stocks when the market does crash with Moo. Thanks for watching. I'll see you in the next video.